Today we're going to talk about self-employed mortgages. When we're applying for a self-employed mortgage, there's much more paperwork required. So what do you need? Well, if we're doing a refinance, we need a good idea of the value of the home. That's important. On a purchase, we pretty much have that established. We need a lot more paperwork. So we would need, for instance, things like articles of incorporation of the company. So, background of the company. We would probably need at least the last 2 or 3 years' financial statements. We would need tax returns for who the borrowers are and the principals of the company. So the point is, it's much more paperwork. The best thing is put as much paperwork together at the beginning of the application to be able to assess what type of mortgage we're going to be able to do. Self-employed mortgages do qualify for mortgage insurance. There's 2 types when we talk about self-employed. So it's either somebody can be self-employed, but they can show their income. So you can be self-employed, and at the end of the year, personally, the borrower makes a certain amount of money and pays taxes on that money. And so if that's enough money that's shown to the government, then you can do a qualified type mortgage. So self-employed is 2 categories. One is somebody that can show their income and prove it, and then there's a second category where somebody is self-employed, but they're not really able to show all the amount of money that they make. They don't show for whatever reasons. Maybe you have a small business, you have a lot more things that you can write off, so you're not showing as much money as you're kind of earning. You're able to write things off that are sort of you're not supposed to be writing off, let's say, for personal, but it's business. So there's 2 categories: one where you can show your income, and one where you cannot show your income. Interest rates are the same for people that are self-employed with an A lender. If we're having the mortgage insured, the insurance fee can be a little bit higher. They have different programs, so depending on which program you fit in, for somebody that's self-employed, the insurance may be higher, but usually the rate is the same. When it comes to proving income, lenders require usually, and what they rely on, I would say the strongest thing they rely on is what you report to the government and what you report to the government personally. So you may have a business that is making a lot of money, and at the end of the year their earnings show, yes, this company made this much money. But what they're looking at for the most part is you're applying for a mortgage as a personal thing. What are you showing personally? What are you taking out of the company? What are you paying taxes on? So when it comes to proving income, usually the lender's looking at your tax returns, and sometimes they want to see an average over the last 2 or 3 years. What are you showing to the government on your Revenue Canada returns that you are personally making? Well, I would say the self-employed programs are not the same, and in fact, even with one lender, they may be different. So each lender usually has 2 types of self-employed programs, as does the insurers. So if we're going to Canada Mortgage and Housing, for instance, for insurance, they have 2 programs, and one is that for people that can prove their income, it's one program, and for people that cannot prove their personal income, it's a different program. So the point is, they're still willing to lend to you if you're self-employed, but you can't show their income. They have a program for you. The cost of the insurance is a little bit higher, and the requirements sometimes can be, even though you don't have to show all of the income that you make, but they have different requirements. For instance, the loan to value might be a little bit less, or your credit bureau report would maybe have to have a higher beacon, a higher score. So you'd have to fit a program, you might have to have better than average credit. So there are things that you can do. There are different programs. You can still get a mortgage. And if we cannot get an insured mortgage or do a mortgage with an A lender, there's always an option of a B lender. We find, and B lenders are lenders that do loans based more on income and equity, relying more on equity of the property, the loan to value, than they will on income. So we find that the B lenders are doing quite a number of these self-employed type applications these days, because they're more concerned with what the property is, and are they going to get their money back? Is their capital secure? And they're okay that you can't prove income. The main key to acquiring a self-employed mortgage is initially and during the application process is the paperwork. we need to show that lender, and it may even include kind of an overview of your business. You know, you may be in a business, maybe it's technology related. You may be in a business that not everybody understands. So sometimes we provide an overview of the business for a lender. We are trying to show that lender as much as we can. We're trying to educate them as much as we can that you are a borrower that deserves a loan. You happen to be self-employed, but you are making good money. You're in a good business. It's a strong business, and it will continue to be. You know, they look at things like that. Well, today it looks like you had a pretty good year, you know, this year. But they want to know, how did you do last year? How did you do the year before? You know, how does business look? Do you have any forecasts? So when you're self-employed, we need to make the lender, you know, feel a lot more confident, you know, about your earnings.